Happy New Year and the sound check, everyone. Welcome everyone to the Kendall Report. It is 2022, if you can believe that, and had a decent time off. I don't feel rested though. Too much going on around my world. Anyway, I appreciate everybody coming tonight and kicking off a new year. Just a couple things I want to talk about before we get into tonight's video and talking about the markets. But there's a number of initiatives that we're going to be launching this year. We started our live trading room late in, I guess around December, late November, early December. We started our live trading room. So that if you want to get involved in that, it's kendallreport.com/trade. You can find out more about it there. Also, there's a couple things that we're planning on doing. I've been threatening you folks for a while with the release of the Trading View indicators. We've found a way to get it done. It's going to be a little rough in the beginning till we get some things automated, but we just need to do it because we keep waiting for certain elements to get together. And as cool a platform as Trading View is, they are not very set up for people doing things like what we're trying to do. A lot of folks have spent a lot of money trying to figure out what we're doing, and we're kind of doing the same thing, trying to figure out how to automate and get a lot of this stuff out to you folks. So that's coming. Live trading room this week, we're going to be focusing in on using the market grid and day trading. That's going to be a focus this week as we come into this week. There's going to be some master classes I'm working on. One of the main things that I really want to do with this channel, when I started it literally many years ago, I used to do a weekly video. Now, as you know, I do daily videos. And my goal with the company, my software, all of those things that I do actually have been about helping people to manage your money. Now, we spent a lot of years, over 2 decades, in working with just investment advisors. We still do that, but we started in the pandemic of offering software to the individual, and that's been really very rewarding, I think, for a lot of folks. And the folks that have spent the time to figure out how to use the software and apply it to their own life has been really powerful. I know we've heard a lot from those folks. But one of the things I'm planning on doing is I'm working on a relationship, being able to actually help with running 401ks, having some of the legal tax things in the background, a whole service around that, because I think for the most part, folks don't want to hire somebody to do their 401k, and we have a way to automate about 85% of it, working on a way to actually automate the actual trade execution. So virtually it would be a robo-advisor to a large degree that you can customize. So I know we're going to get this done sometime in the next quarter or so, and I'm excited about that as well. Hopefully all these things will come together. We'll start to really bring you into the world that I live in. Instead of just looking at my indicators, you're going to be able to use a lot of these indicators. I think in totality there's 9 of them, which include cycles and Fibonacci projections and some other things that are out there. So I'm really looking forward to getting that out there. So hey, new year, let's talk about what's going on in the world. Very interesting world. I have to say the word Omicron, and I've called it Omicron, and now it's looking more and more like potentially just a common cold. And so, just not to promote like it needs to be promoted. If you haven't watched the Joe Rogan and Dr. Robert Malone video, watch that. Very revealing. Some things that I've been talking about in private are on there. But the point of this is that we're seeing something that I think is I think it's called mass formation psychosis, and we're seeing it in the markets too. When I was listening to that podcast, I realized when they were talking about the things that are going on in the media, we deal with it every day in the markets, and it's been a very unique thing. We all have watched it happen. We've seen a couple rug pulls on Fridays where they've dumped these markets on. Just to mention that, remember the day there was one Omicron case and they just dumped the market, I mean, really hard. And of course, the next day it came back because uh, there was no substance to it, right? And there may be a couple deaths, but they're not really getting the traction. And I do mean that I believe there's people out there that are wishing that there was more traction on the D side of the equation. And it's fortunate for all of us humans that are living on this planet that they're not. But the point of what I'm talking about here is we're seeing some things happen that is very, I guess the best way, not a conspiracy, but we're seeing the news media, the financial news media and other outlets starting to dominate. And I think what we're not even seeing humans write these things. I believe there's algorithms writing these things, which are then triggering the trading algorithms. Maybe it's the same people, think about that are generating these things. And we're seeing this crazy volatility, and all of a sudden the markets flip on a dime. There's a couple of things I've been watching intraday, especially since we started the live trading room, that I think have been really interesting from my viewpoint, is we're seeing these 15 and 20-minute spikes in volatility where it's just random, where sometimes it's as many as 15 to 20 handles, which is 100 points in the S&P, just ripsawing back and forth. We saw a couple of those situations just late last week after I got back. And so I guess what I'm talking about here is that we're seeing these algorithms get triggered, the trading algorithms, but I also think the news is being generated by bots as well. So it's going to be interesting if any of this actually, this is total speculation, not really trying to throw a conspiracy theory out there, but I keep seeing these things, and there's no data behind these things, but they're able to move the markets in big ways. So as a group, we should be watching out for that. So make sure if you see things like what I'm talking about, please comment on the channel, and don't forget to subscribe, by the way, if you like these videos and like this channel. We're sitting here, it's almost like YouTube is keeping us getting over 30,000. We've been at 29,500 to 800 for nearly 7 or 8 months now, and it's somewhat interesting that we don't get over that number. I think there's a reason for that, but we'll see. So just from the standpoint of what I'm talking about here, just comment on this as we go through the week. If you see some things that seem kind of suspicious, I would like to do that. I try to read a lot of the comments on the channel, so feel free to do it. Even those of you that are trolls and like to tell me how wrong I am, I appreciate that as well. I've seen a couple things that have really been helpful for me. So let's just talk a little bit before we get into more of the technical stuff, but let's talk about some of the things happening this week. It's unemployment week, first week of the year. We've got unemployment coming out on Friday. Tuesday, we've got ISM manufacturing coming out. We've got JOLTS coming out, which is the job openings last month. There was 11 million jobs out there available. So there's certainly plenty of places for people to go to work. So the traction keeps coming on. As you know, we go into Wednesday, we'll see ADP numbers coming out, expected 420,000. FOMC minutes will be out as well on Wednesday. Might be some nuggets in there. Certainly it'll be heavily read, and maybe there'll be some reaction to volatility there. On Thursday then we've got the claims, 198. They've been kind of coming up a little bit lately, and the continuing claims are down at 1.71. That's a really good number. I think you folks have been watching the channel for a while know that I've been talking a lot about this 2 million mark, and once we got below that, it would be reasonably impressive, and it has been that. There's definitely employment. I've talked, I think, for 2 months about how I thought things were going to hit the wall, and then of course the we'll call it the phony Omicron came in and said, you know, that everybody, what was it, they were predicting that there was going to be 70% of everybody was going to have this stuff by Christmas, if you recall, and that was a little bit off, that number. But the bottom line is what these numbers are pretty good numbers. And then we come into Friday, we got jobs expected at 425,000, unemployment rate to come in at 4.1, and then we have consumer credit around 18.2 billion. So there's overall the economy is continuing to be stable. And the final thing that I'll talk about before we get into the technicals tonight, and I am going to go through a number of things. I'll try to get through them as fast as I can so we can all get back to our evenings and move forward. But the thing I want to talk about is our great Congress and our current administration with the Build Back Better bill. That in itself tells you it can't be that good, right? But a couple things that I'm going to be trying to unpack as we go through the week and maybe the next couple of weeks. Usually takes me probably the better part of the first 2 to 3 weeks of January to get a feel for what kind of rotation, where we're going to go with things from the standpoint of, you know, rotation in sectors or asset classes or whatever. It takes a little bit till you see. You can't just make a guess. I know everybody likes to put out their expectation for 2022 as you come into the new year. I always like to wait till probably around the 1st of February, get a feel for what kind of cash flows we're getting, and then start to do some forward looking. And I think that's going to be really interesting. So I'm going to continue to ramble on just for a couple more minutes here. But if they do pass this Build Back Better bill, that thing is loaded with all kinds of taxes. And there's incentives, there's stimulus, there's all kinds of stuff in there. But it's going to be a little bit, if they do pass it, even if it's a downsized version, it's going to be interesting to figure out who's going to be the winners and losers from a taxation viewpoint. I've talked about this off and on live streams for a while now, is that taxes matter. And I started in the markets about, I don't know, 8 months or so before Ronald Reagan came in the office. Jimmy Carter was president, and interest rates were huge. They were at 16% and at an all-time high then. And we also had the stagflation, the inflation that was out there that Paul Volcker was fighting. So we had a lot of cross currents at that point in time. And now what happened then was Reagan dropped the rates from almost 60% tax rates, you know, down substantially into the 20% and lower in some brackets, and dropped capital gains. Markets went vertical, you know, all the way until the 87 crash for the most part. There was a couple flat spots, but there was an overall incentive based on the taxes were good. And at the moment, as we sit here, we are absolutely still running on the 2017 tax cuts. So the economy is doing really well because it's running on those taxes that were passed in 2017 and all the changes then. So if they do something here and get this Build Back Better bill passed, it's going to disrupt a whole lot of cash flows in the economy. And the job is here, and I've always told you folks, our job is to figure out where the cash flow is going to go. If it's coming out of here, where's it going? And that's what I'll be spending a lot of time in trying to figure out what's happening from that standpoint. So that is certainly big time on my radar, and that's going to keep a lot of uncertainty in the market. So the last little part of this rant is that one of the things that is going to be difficult, I think a lot of folks found last year difficult, especially some of those folks that we talk about, the so-called, growth stocks, where I saw something really funny. The expectation for the price for Palantir in 3034 was $25. I thought that was hilarious because that thing is flatlined between 18 and 25. But all these stocks that are out there that are called growth stocks are companies that were IPO'd in the last couple of years. And some of you may not be aware, but if you took the Fortune 500 in the year 2000 and you looked at it today, over 50% of the stocks don't exist anymore. Some of them were bought out, but a lot of them just went away. And folks don't realize, just like in the little penny stock markets and the OTC penny stock, these companies come and go. The hype is much more sophisticated at the next level when they come onto the Nasdaq, but it's really not that much different when you get to that part of when you start looking at stocks and valuations. So a lot of folks are extrapolating out these big returns for these stocks based on what they saw last year, and it's probably not going to work out that way. But the hard part's going to be this year is figuring out where that cash flow is going to go. I think there's some mild, I would say, bias toward maybe the small caps trying to come back again. You know, when we look at what happened last year, S&P finished up 26.9%, and Nasdaq up 21.4%, and then the Russell was up 13.7%, and Russell was up 18% back in January. So it just went sideways and faded as we went into year end. But there's just so much that's going on from the markets from my viewpoint, and I'm going to go through our database next, because that is probably the most, I would say, somewhat puzzling, but I'll cover that here in a minute. But there is a lot of cross currents and a lot of things that aren't adding up right now, especially trading basically at all-time highs on the market. So let's go ahead and go through the database, take a look at some of this stuff, and see what we've got. So let me zoom in on this page here real quick. So our intermediate database is at 29.15 bullish, which is very interesting. I'm going to show you a chart that illustrates what this is, and this is a very low number, especially the way that we've rallied. I think we were up in the final quarter of last year, we were up about a little bit over 10%. So it was a pretty robust rally in the year end, but it was very narrow. And this chart here actually shows you from our database viewpoint where we peaked out way back in early 2021. We spiked up, we got this, what I call this rebound above 60%, and now you can't see this chart, it's kind of hard, but this number is way down here at the 29%. This is an old clunky chart, but this is really showing you that the participation in this market is very narrow, and I've been talking about this for a while, in that because it's narrow. Yeah, so we're having trouble. Are we having trouble with the mic? I see someone saying something here. It looks good on my end. Okay, so I'm just trying to wait to see if we're having some issues with this mic. I'll just get a little closer here to it, so make sure it's getting plenty of action here. But this 29%, somebody's saying the market grid isn't showing. I'm showing right here at 1322. So I don't know, maybe you're something stuck in your cache on your browser. Okay, so let's get back into the flow of the show here. So this 29% is a very narrow number, and what my expectation is that we're going to get some more traction, but this is going to take weeks to get the traction, and this is where we're going to find out whether the small caps are going to come back into play or what kind of flow we're going to get. Let's go over to the dailies short term. The daily short term has got reasonable good traction here. Let me zoom back in on this. It's up to 48.12% bullish now. And I'm going to go over to what the output of the data is. And you see a couple things. We got on the weekly, we had 443 buys, 284 sells. So we had a slight positive rotation that pushed us up to the 29.15 bullish. On the daily or the short-term models, it's up at 48.2, and I talk about this number all the time, that we need to be above 42%. So that is this is strange. I'm just trying to figure out what's going on with the mics, folks. So I need to know, does this sound bad or good? I'm getting mixed signals. Some are saying good, some are saying bad. All right, let me check something, folks. So tell me if the sound is okay on this screen. I think it is related to that screenshot. It's funny, Brian. So let me know so I can get back into the flow of things. All right, folks, I'm just, give me just a second here, okay? There's definitely something wrong with the setup here. Nice way to start the first broadcast of the year. Let me see if I can get this headset to work. Okay, Is that much better? Looks like it's pegging out now. So I'll have to look like an airline pilot to finish this tonight. Okay, I'll just go with the headset on because this, yeah, I'm not sure what happened. Okay, I really apologize. Thanks for your patience, folks. Now it's too loud. That's funny. Should be about right. This looks good to me. Okay, sorry about that. So to try to get back into the flow of the show, nothing like your first show of the year to have equipment issues. Yeah, I can turn this down. So now you have to turn. Yeah, funny boomer. Yeah, screw you, Tim. I've been doing this for a long time. I tore down some of my equipment and I didn't check all the settings because I didn't didn't change anything. But obviously, yeah, I'm getting really frustrated here. All right. That's hilarious. Nothing like disrupting. So okay, so let's just move on. Let's get into some of the technicals. So I'll try to get through some of this stuff here, and we'll get into looking at some things here. Let me just make sure because it looks like all of these. I need to check something because it looks like the mic settings got changed somehow. Bear with me one more minute. We'll have all this fixed. Okay, looks like we should be good. Yeah, let's get on with it. I agree. I apologize. All right. Next time I'll know after I unplug everything to make sure I check every setting. Yeah, I don't know what you're talking about, the weekly data not being updated. So I will check that out after the show because mine shows it's updated. Anyway, so onward. So let's get on to the back into the flow here. Markets are starting off on a fairly strong note as we come into this new year. We're looking at, as I get over to the daily on E-mini, there's something that's happened. We've seen this huge contraction of the volatility through last week's holiday week, even though we saw it just kept getting narrower and narrower for obvious reasons because the markets were absolutely just very quiet with the holidays. But what we're seeing here is PPM1 is actually accelerating. All of the stuff that is rotating up here, PPM2 is at a plus 0.21, 0.35 on PPM1, and PPM3 is not turned up yet. But we do have some Fibonacci objectives above the markets. We're looking at a min target of that we've already reached at 47.78. The next level, 48.76 and 49.37. Now, one of the things I'm going to cover on this particular sequence of analysis is I want to get in and look at some just briefly at the long-term chart. So this is actually a pretty good sign that we're going to go to these next levels, and all of a sudden we're going to be looking at a 5,000 handle. Yeah, so okay. Okay, I'm going to close this line down because you guys are distracting me so I can get into the flow. Okay, and I'll come back up when it's time to look and see what you're doing. So the pattern that's setting up here on this is pretty bullish, at least for these intermediate cents. All of a sudden, we've got targets easily up into the 5,000 handle. And I'm going to talk to you about something I believe is happening on a longer term basis when we get into the cash markets. But we go over to the market grid and expectations for today. We've already printed, as we sit here right now, we've almost printed an RXT level already, 47.87. In the past, when we've seen this type of action, we've seen the market move back into the range. So we're basically at an extreme, so I'd be very careful about expecting prices much higher than where they are right now. We'll look at the weekly on the S&P cash to get a handle on that. But as far as let's go ahead and take a look at the SPX and set up some expectations there. So tomorrow, the RTX for the S&P cash is 47.93. That's up about 30 handles. So I don't expect that we're going to get to those kind of levels on. So we're looking at 47.93. We could see that print. That would be about 30 handles higher, but probably an R3 on this is probably going to be it. This is the daily. S1 47.59. That would be an extreme. If we did print below 46, print below 46.76. What number is this? This is not, there we go. I had clicked on the wrong spot. If we printed below the 47.71 number, that would be pretty much a pivot on the downside. I don't expect that to happen. Looking at R2, 47.93, then R3, 4800, 4807, which somewhat matches with where we got last week. We got up to 4807 on the 28th. So this pattern is still bullish. We've got this underlying strength with the PPMs and all that are in flow. So that is going to be that's going to be the expectations there. Let's take a look at the weekly. Then I want to talk for a minute on the longer term charts. We're going to look at a monthly, then we're going to look at a quarterly chart. So what's interesting is there is a weekly cycle coming in here. And when we get these cycles at an all-time new high range, this could end up to be a high cycle, but it won't be completed until Friday. So I'll bring that up again. The PPMs on the cash are still very strong, 0.48, 0.35, 0.45. So trend mode is in place, angle of attack is in place. So there's no real worry about any kind of real downside in this market right now. That doesn't mean it couldn't trade down to a 40, maybe the extreme for the week, 46.85 on the upside, 48.11, 48.56 on the upside on a weekly basis. There is a Fibonacci target that's coming in here. These are new targets. I talked about this several weeks ago, that we were likely to see some new targets get formed here. And now we have a high target of 49.60, 51.37, and 52.47. So there's the minimum number here is for 49.60. So that's 200 points higher. Let's go to the monthly and take a look at that. So as we look at the monthly, the expectations for last month, I want to review last month. 48.17 was the RXT on for the month of December. We got to 48.08. This month we're looking at 48.31 is R1, 49.03, 49.76, and 5,041 is RXT on a monthly. And what's interesting about this is we have huge acceleration on these PPMs. If you look at these PPM 1, 2, and 3 here, they are just accelerating. So this trend is not going away anytime soon. So I guess I'd put my money on that they're not going to get Build Back Better passed. And I believe every month that we get 1 month closer to the elections of this year, we're going to see a lower probability of getting that bill passed. So this is an extremely bullish chart. I'm going to go over to the trading view here, and I've got, this is, I've showed you this chart before, but this is the wave count going back to 1872. This one here is the top in 29, and this was the bottom of the wave 2 bottom here. And then we got wave 3, and we're wave 5. Excuse me. So I did what I believe is an estimate of where this wave 5 is likely to complete. And believe it or not, it's probably between 50, I'm going to say this out loud, 5,800 and 6,200 on the S&P. So you start to see a lot of rhetoric out on the internet talking about, 10 or 20% sell-off this year, interest rates going higher, inflation's going higher, all that stuff. We'll talk about the interest rates and inflation here shortly. But this is not at all like I guess any sort of a top here. In fact, seeing acceleration in all the PPMs on this, it's just a huge, huge trend, and it's not over. And there's a couple things, if some basic Elliott wave thoughts here is that typically the length and magnitude of wave 1 is what wave 5 would be. Well, if you count wave 1 here, it was from basically, if you know history a little bit, there was one of the longest depressions there ever was in 1877. There was a banking collapse of 73. And in Europe, it went on for 20 years. But you can see that on this chart here, it was approximately 40 years long. So if we tried to extrapolate that out, it would make no sense at all. But if we just take the last leg of this thing, we're looking at 29 to 32. So the bottom here was 2009. So we're looking at this thing's already getting extended from that period of time. And it looks to me that these targets are going to be reasonable between 5,800 and 6,200 on the upside. Now, is that going to happen this year? I don't think so. That's like 60%. So that's not, this is a multi-year projection, and these trends on this 3-month basis or on a quarterly chart like this, they don't turn very quickly. So there's some very long-term trends. There's a lot of power behind this. So it's going to be interesting. Maybe the Great Reset really was a great reset, and everything's getting restructured and all of those things. If you follow me on Twitter, I posted a video. I drove to Texas several weeks ago, and on I-10, it was absolutely insane how many. I had one spot, I took a picture that was probably, I'm going to call it between 5 and 8 miles long, of 18-wheelers stacked up. And in most cases, they were controlling both lanes of the freeway. They no longer are courteous. They don't care about what's going on. So the amount of of things that are going on in this country, and I think we'll call it economic enthusiasm is pretty amazing from what I could see, and I saw some crazy things in when I was back in Texas as well, including gas prices at $2.60 a gallon. I thought that's 2.61, and but the point is that there's just there's an expansion going on here that is likely to continue. So I guess I'm basically falling in the camp of the Roaring Twenties type mentality, and it just looks like to me that there's some big mega trends coming here from that standpoint. So my guess is that we're probably not going to see a massive increase in the taxation. Some of these things that are likely to happen. Maybe there's more stimulus. Who knows what's going to happen with that? But ultimately, this market's just got so much power behind it. It's going to be very difficult to talk about. So I'm going to try to. I'm already getting in to longer than I want to be where I'm at on this video because of our hiccup with the technology. So what I'm going to do here is I'm going to get through the rest of the indices, try to cover a bunch of stuff, and as we go through this week, we'll get into more details of what the expectations are for this year. But I think that's going to be the best because of the hiccup with the technology we had earlier to get through this video tonight. So let's take a quick look at the Nasdaq. Up 96 handles, up 0.6 on the evening right now. So it's quite a bit of strength, and there's a solid bid in here. But same things are happening here from the standpoint of what's going on as far as the ranges. Let's get over to the daily chart. And you'll see the same thing's happening here. We're already printing right now very near, we're at high 16,427. We're almost at R3. RXT is 16,482. That would be the extreme, but if we look at the PPMs, they're doing really well. This is daily, up 0.39, 0.12, and 0.009. The PPM 3 is basically flat, but 1 and 2 are the primary trend indicators, suggesting there's some good acceleration underneath this market here. And I'll draw in the pattern that looks like it wants. You can see there's some Fibonacci targets in this pattern here, which is minimum target, which we've hit is 16,407, but 16,756, 16,972. So we're heading for probably 17,000 plus. Let's go to the as far as expectations for today. S1 would be 16,282. That's a long ways from where we are right now, but as I said when we were looking at the S&P, it's very likely that we're seeing the prints. I've seen this story before where we're printing overnight. We got all this enthusiasm. By the time we come into the opening in the morning, it may continue into the open, but then there's some fading once the U.S. markets open, and especially with employment numbers and those kind of things coming out. So I just don't see that happening. So let's take a look at the weekly range expectations. 16,480, that would be R1. 16,658, and so we're looking up at these ranges around, moving up towards the potential this week up towards 17,000, 16,995. And the PPMs here aren't as clean, but maybe a quick refresher if you're first time watching the channel. One of the things that I talk a lot about, and we've been in this mode for a while on this, is these indicators here. They basically have a little bit different configuration, especially these primary, as I'm just going to draw in what these things usually do. And this is where the momentum surges on three different levels. I believe there's three primary trends in that get set up, and then these indicators flatten off and they go into what I call trend maintenance mode. And the trend maintenance mode is all about this angle of attack that we see that are coming up through this pattern. And it flows pretty much around the bottom end at the 40, but the 21 period moving average tends to be the primary demand line for this type of pattern when it sets up like this. So this it just continues to be a bullish pattern, and this flag here is set up right now. If you look at the Fibonacci projections, we're looking at minimum 17,176, 18,2 to 18,900, so almost 19,000, and these are current and valid Fibonacci projections that are on here right now. So there's some huge upside probabilities. We're trading right along this 10 period moving average, which is currently up at 0.35. So that's going to be your demand line right now, which is right at this is the weekly, so right at the 16,161. That's going to be probably your buy the dip level from that standpoint. Let's take a quick look at the Russell. We're just going to do weekly Russell. This has been a pretty tough market to follow, but we continue to see some minor improvement along this line. We're right at the key areas. This is weekly, 2276. Between 2260, we'll round it off to 2276. This is the cash. We need to get above that 2276, and then we'll start to see some acceleration. Just flopping over to the spread very quickly here is what we're seeing is a bottoming in the spread, which says that we might see some leadership come back towards the small caps, as ultimately when you're trading at these high levels on these markets, you get what I call markets start to go for a rotation. Market participants are going to start looking for cheap stocks. So maybe some of those beat down stocks that are in these so-called growth stocks, maybe they'll get some flow here for a little bit. But that's until everything gets proven out, especially like I said, early in January can really set the tone for the rest of the year. And I know the way the first week goes is the way the market goes for the month, and the first month, all that kind of stuff will project what's likely to happen for the year. I don't really buy into a lot of that stuff, but we are likely to see some minor trends form from cash flow, looking at sectors and everything else. If you recall last year at this time, I was really strong on energy and on the financials, and everybody seems to be focused on financials. I didn't go through that tonight, but if you remind me tomorrow night, we have no glitches with the sound, then what we'll do is we'll actually go through and look at some of the sectors, and because some of these sectors on an intermediate level are still long, and they are extended quite substantially, especially in financial and even the energy as far as that goes. So there's likely to be some rotation from those things back into some other areas that I think we'll be watching for. Don't have those answers as of yet, but I'm looking to put that together in the next couple of weeks. And just a quick mention on as far as everything goes, I'm just bringing up our platform here. And one of the things that we've been working on is we have built, we're in the process of finishing some indexes. There's going to be, it's probably going to end up to be the we were working towards a WaveTech 100. It looks like it's going to be a 150, but we also broke down all of the industry groups. So we have telecommunications, technology, tech consulting, software. So we've got all these subgroups, and we built indexes on them. And even things like energy that I'll put up on the screen here, as far as that goes, you're looking at this was the index performance up 54% last year. So it was a pretty good area, and there's 18 symbols in this index. So we're going to be putting out a whole bunch of stuff. We're going to start putting these metrics probably on our Portfolio Expert website. We're working on a space to put that, and that'll be just on the front end, so you can go see that. And but yeah, so those indexes, we're hoping to have them completely released here fairly soon in the next couple of weeks. It's a project that's being completed right now. So, okay, so let's move on and let's go next to interest rates. And let's take a look. Somebody was mentioning, I noticed on Twitter when I was off, I was talking about this 13-week Treasury bill that I was talking about. It was up at 70, and the Fed doesn't want it up 70, kind of gapped up. There was probably some imbalances that day. You can see it traded down, then it went back to around 65, and now we're back to 33. So this is where you're going to see some of the shortfalls in liquidity. Fed's going to come in and do repos or something to get this to come back down. So there's a lot of trading that goes on from the Fed on the open market desk as far as controlling some of these things out there. But we go over to the 10-year, and we're back at, I thought this was interesting when I was looking at this a little bit ago. Bear with me 1 second here. The 10-year is at 151, and it's been in this little sideways range. This is the 60-minute. Let me get over and go to the weekly. This is what was coming up. There's still a bit of negative rotation on the 10-year, meaning that there's still a cap on the market about 154. But another week going flat into this range should be enough to start to turn PPM1 up, and then there's some new objectives that are coming in on the screen here. And they're right here, and the targets on the upside is all of a sudden we're coming back into that 200-day moving average, which is at 1.8, and then we have Fibonacci projections now for 1.9, 2.12, and 2.25%. Now these don't have to be hit right away. We'll get some of these Fibonacci's to pop up, but if we start to see the PPMs turn, all of a sudden we are going to be looking at the intermediate rates on the 10 and longer rates start to move higher, and that'll be what I'm looking for from that standpoint. And I believe from the whole expectation of inflation, I think it's kind of interesting that the Fed denied the inflation surge all year, and then they finally capitulated and said, oh, it's not transitory anymore. Since they've said that, and all the inflation metrics have been down. It's like a classic where you get out of a stock when it's went down for 3 months and you finally can't stand the pain anymore. So you exit out and it goes straight up. And that's exactly what I think the Fed has done. It's potential that maybe it ends up to be transitory, which is kind of funny. I could tell you that I-10 scene that I talked about a little bit ago, it was pretty amazing because there wasn't container strapped to a back of a truck, right? They didn't drop the container on the 18-wheeler. All of these things the containers had been unloaded and reloaded. And I'm talking 700 miles, 800 miles of this stuff on the way out. It was absolutely insane, the amount of truck traffic. Every truck stop, every rest stop, everything was full. Maxed out. It was absolutely nuts. So, so I think the supply chains are moving pretty good right now. Everything's starting to loosen up, but it just may be that we don't have the inflationary pressures. But what we will have is that is not the only thing that drives interest rates higher. What I'm talking about here is demand, and the demand is actually driving these interest rates higher. We saw when some of the inflation numbers were coming out, and they were crazy numbers, right? 9.8 year over year and all that. The Treasury's downticked. You're thinking, wait a minute, how could that happen if this is inflation so high? And this market will be driven by demand, and that's going to be a good thing. So maybe there's more in the financials. I'm still unpacking that as far as putting some things together on that standpoint. So I will come up with some of these answers, like I said, over the next week or so as we go through markets and we see them trade in this new year. But this is an interesting scenario, especially when we go over and look at the yield curve here. And you folks know this is the 1030 spread. It has started to steepen. It's pulled back in a little bit. The same with the 530. You'll see that here. It came up a little bit. It's back down. I believe the 210s right now are at 78. They've done the same thing. They started to steepen a little bit, then pulled back in. So we're really just not seeing any super steepening of the yield curve, and that's important for us to see that. And I've been talking about this 530 spread should be closer to 0.9. I would say 0.8 to 0.9 would be much healthier for the banking system, and that would keep some pretty good liquidity and should be able to give the banks enough incentive to keep lending and doing those kind of things from that standpoint. So all of a sudden, the only thing that's contrary to what I just said is how gold's acting, and I'll cover that in a minute. It's definitely acting like people want to own gold again all of a sudden. So we'll talk about that here in just a second. So let's go. What I want to do next is actually go over, and we want to look at. We're going to go to crude oil. So here's the plan: crude oil, gold, and then. Matter of fact, I'm going to do the Dower crude oil. I'm going to throw the Dower in there tonight. Dower crude oil, gold, and we'll do Bitcoin, and we'll call it quits. Sorry for the super long, but we wasted probably 10, 12 minutes, maybe more, trying to get the sound to work right. So I apologize for that again. So let's take a look at the Dower. And the Dower's very interesting. I know a lot of folks think I'm crazy because I've been talking about the Dower probably going up to par, and this DXY, it's about 47% against the euro. So this is kind of a euro play in a large degree, but the bottom line is we're remaining above the 200-week moving average, which right now is 95.08 as basically your support level. And if we get back above some of these higher levels around 96.60, 96.70, we'll start to move to the next level up. And I think we'll see 98 to 100. I don't see a lot of downside, but what we have seen is just as slightly creeping back. We've seen a bid come into gold, which I'll cover here in a minute. But the bottom line is the Dow still has some pretty decent underlying trend. It's not super robust, but there's enough for support levels to hold and probably continue to hover right above this 95 level for right now as far as the staying over the 200-week moving average. All right, so let's go to crude next. This is weekly crude again, and I think that this chart is becoming interesting again. If you remember, the administration did a little victory lap on how gas prices dropped 10 cents. Well, that may not be what is going to happen from here, because all of a sudden we still have some work. It's interesting that both this market and the treasuries are lined up very similar, but as long as we stay above the 70, as long as we stay right above the 73, the key level on the downside is around 70, 69, 60. We stay above that over the next couple of weeks, we should see some acceleration, and then it won't take much to start to project up towards some of these numbers. And these go back to similar numbers that I talked about before, and it's almost identical projections. If you see these dots that are up here where I've got my cursor, those objectives were 88, 101, and 109. The new objectives being generated off this pattern are for a move to 86, 8670, 9602, and 101. So we're looking at the potential of 90, 96, 101 numbers. So I just talked about how inflation maybe is peaking out. There's a lot of cross currents right now, and that's going to be interesting to watch, just to see how all of these elements play out. But this is going to be one of the key elements as far as that goes. And so far what we've seen from these markets is that the movement in the dollar is kind of contrary to how you would expect it to be going right now. And I think there's just still a lot of demand for U.S. securities and things like that, with the markets trading higher like we've been seeing. So the U.S. continues to be somewhat of the safe haven. I believe the French index was the best return on the planet, around 32%. It was a little bit better than the S&P at 27, but there's just a lot of cash flow into the U.S. right now for a multitude of reasons. So let's go to gold next. Stay with the weekly chart. Gold is up at 1827. We saw a nice little rally in the last couple of weeks of the year, specifically the final week of the year, where we were trading up to the 1831 level. We're still somewhat hovering right in that range. We had a high of 33 tonight, so we took out last week's high, but the PPMs are all starting to accelerate. I've been talking about this pattern for probably 5-6 weeks, that this is a bullish pattern, and the next levels for us to watch for is a move to around 1882 is going to be the next target. So about another $50 on the upside, and I think there could be much more in this market if we get above there. This old high that we had back in November was 1882. It's interesting that the Fibonacci target, that it hit right on that target, and now looks like we want to retest that again. So if we get through that, the next levels are all the way up at 1940 plus. So we'll talk about that when it's appropriate. So some interesting things to talk about here on Bitcoin, the final market, and this weekly chart. I had talked about this breakout number some time ago. It stayed above it for 2 or 3 weeks and it failed. Now what we're seeing happening, we're seeing some weekly downtrend form. The PPM1 is a minus 2.68, which is a huge trend down that basically is going to cap the market off at around 54.8, but that number is dropping at about $2,000 per week. So that's going to be 52 here in about a half hour. And then the next number is that we'll see the PPM2 is actually coming through its first and second derivatives. So we're starting to move this market down. Now there's 3 targets to pay attention to here. 43,730. We had that spike low over a weekend, several weekends ago, where we printed down to 41 handle. But this is where it gets somewhat, I guess, if you're a hodler, where you're gonna have some sweaty palms. 34,000 to 28,000 is a valid projections on the downside right now, and it's becoming somewhat vulnerable. I'm going to show you the daily chart here, and when we look at the dailies, you'll see some new downward objectives: 28,000, 19,000. These are pretty ridiculous numbers. 14,000 on Bitcoin. I don't see them getting there. The one thing that's in the positive mode as far as it goes is we've been hovering for the last, we'll call it 20, 25 days. I'm not going to count these days, but last several weeks, we've been hovering right above the 200-day moving average. 200-day, 46,508. We're trading last 46,912. So we continue to hover around that. It just needs to actually trade above the 48.5 level, and that will at least set some stability and maybe burn off some of that downside pressure. But the 48 to 52 is going to be the upside, and a critical level on the downside is going to be at around a 46.5 number. Below that, we have to go to the 44 handle that I just talked about, and there could be some pretty substantial numbers that would suggest much lower prices. But it looks to me at least some stability. The shape of the PPMs on a daily are at least telling us there's a few more days. Maybe we can get some stability through this week, another week or two of stability along this line, and we'll start to bleed off some of that downward pressure and suggest we can hold some of these support levels. It's been pretty boring, to say the least, to be involved with Bitcoin for the last, we'll call it 4 or 5 weeks. So that looks like what we should be watching for on that from that standpoint. So if you look at the market grid for today, 44,349 is the extreme, last 46,920. So I'm just, I'll go ahead and stay with the headset. Sorry for the glitch. It's amazing. All I did was unplug a bunch of stuff and plug it in, and I thought I checked all the settings. It looked good, so I apologize for the audio. So we'll get back in the groove as we go through the week. I'll come up with some of these answers that I talked about tonight as far as where the rotation is going to be, sectors, asset classes, all of those type of things are what we're going to need to figure out as we come into the first of the year. And if you're a software user, WaveTech, or on Portfolio Expert, as long as you've done all your screen setups, you're fine just following that process until typically I like to update my portfolios not for January, but in the beginning of February. So anyway, folks, thanks again for watching. Sorry again for the little snafu. And remember to subscribe and like these videos. I'll see you tomorrow night. And I'll see those of you in the live room at 1 o'clock tomorrow on in the live room. Thanks a lot. See you there.